and this is Rick Sadler with Hit and Run Candlesticks. I appreciate the invite. It is truly an honor. I do need to start out with a special thanks to a few people, and my first thanks is going to go out to the members of Hit and Run Candlesticks and Right Way Options. Without their continued support, we wouldn't be here. And the way that they support the trading room is absolutely amazing, and it's what keeps it one of the best trading rooms out there. I would also like to shout out to the Warden Brothers and TC2000. That is my charting platform of choice, and they are providing all the charts and the scanning material that we'll go over today. So I want to just shout out for them to say thank you. Now, toward the end, I've got a couple of scans I want to share, and they are TC2000, and I know not everyone uses TC2000. I understand that. We can provide the scanning codes for those scans pretty much for whatever program you use. You know, you just have to contact me, and we can make that happen. So, alrighty, a quick little disclaimer here. You know, trading is risky. It's just as simple as that. Usually whenever you do something that has risk, it has also the greatest return possible. So we have to be very careful when we trade. We have to one, realize there's risk, and we have to make sure we use protective rules such as stops or whatever you may do to protect from major losses. Please realize that you never want to get out there and trade. You don't want to roll the dice. You've got your whole portfolio out there. You just don't want to put everything on one trade. You just don't want to do that. It makes no sense, and it's just too risky. Alrighty, here's our website here, our home page, and if you're interested in any follow-up or anything, you can click on the contact, and they'll send an email directly to me, and I'll be happy to answer your questions if you need any questions answered that we don't cover here, because we are limited to time here. One of the main things you could do is if you want to sign up for the free trade idea, and that would also put you on the list for the upcoming free webinars that we have planned over the next 3 weeks with Hit and Run Candlesticks or Right Way Options as well. All right, enough of that. Let's get down to business here. Again, I want to say thank you very much for allowing me to be here. Again, my name is Rick Sadler with Hit and Run Candlesticks, and this is an introduction to trading the T-line. The T-line is simply the 8 exponential moving average. That's all it is. It's no trick to it. It's just simply the 8 exponential moving average. The T-line was created when I needed it most, and when I needed it most is when trading was at its absolute worst for me personally, and I had to do something to make a change because I was just so determined to be a stock trader. Well, that's how I came up with the T-line, and there is a long story there. I'm not going to bore you with it today. If you want to come into the trading room or one of our free e-learning classes, I'll be more than happy to tell you this story. I think it helps with understanding the T-line a little bit. The T-line, it stands for trigger or trend line. When we were naming it, that was 2 of the names that came up because that's what it actually does, and I just shortened it up to T-line, but it stands for trigger or T-line. For swing trading, I find it absolutely great for swing trading. That's where I mostly use it. I use it, my chart of choice would be the daily chart. I do use intraday charts, and it can be used on any time frame that you use it on. I am predominantly a swing trader, and that's what I use it for. That's what we'll be looking at today. And the T-line is I call it a directional beacon many times, and it is. It keeps you on the right side of the trade. And when you combine price and maybe another indicator or 2 we'll take a look at, you know, that price action with it, then you have an extremely powerful visual on a trend and a definite yes, I'm on the right side of the trade, or no, I'm not. Meaning if you are long and we start trading below the T-line, then you're not on the right side of the trade. And what we're going to do here today, we're going to add the 2 exponential, a second moving average, since the T-line is a moving average. We're going to add the second moving average, and it will be the 2 exponential moving average. That was the original. Some people have adjusted that to like the 3, which is fine. I mean, I think when it comes down to it, most indicators, most people adjust to their liking anyway, and it's very important to make sure it fits your you have to be comfortable with it. And just because I'm comfortable with it using the 2 exponential moving average, it doesn't mean you are going to be comfortable with that. And there's no one, so we'll call it a so-called strategy out there that is a one size fits all. It just doesn't work that way. I wish it did, but it doesn't. We're going to take a look at some scanning for the T-line, share a couple of scans with you. And then again, I think I already mentioned it works on any time frame you want to look at, anything from the 1 minute to the 10-year if you want to look at that. This right here is very important. This right here is something I think is worth writing down and actually putting it in a place that you can visually see it. Don't wad it up, put it in your desk drawer. Don't put it between 2 pages of a 3-ring binder or anything. Put this up on your computer. Write it on a sticky note. Go to Walmart and buy a $1.95 frame. Put it in a frame. This is so important. It's not the magic of an indicator. It's the consistency that you use it. We've all got indicators that we say are the best indicators out there. The truth of it is, they're all pretty darn good. They really, really are. But the trick is to find one you understand, not one that somebody else makes a ton of money on. Don't do that. You've got to understand it. Just because they make money doesn't mean you're going to make money. So it's important to find one you understand and one that you can explain. So in other words, if you can come on the phone with me, you can call me up, you can Skype me, you can be in the room, whatever. If you can explain to me how to use that indicator, then you probably have a very good understanding on what to do with it, and you're one step ahead of so many other people. And then consistency. You've got to stay consistent with it. You know what happens a lot of times is people will hit it big. I mean, they will just hit it big. That indicator is working terrific, and it's still working, and it works. And all of a sudden, it's not working for a few days, maybe for a week. So you know what they do? They go out and they find another indicator. That one quits working after a while, and then what they do is they go find another indicator. And then maybe, let's see, what other color do we have here? How about that? Then they find another indicator. Well, this may have lasted a couple of days. Maybe it lasted a couple of weeks or something like that. But when it comes back down to it, everybody comes back to the same one that they're always comfortable with. So if you just stay with what you're comfortable with in the long run, I think you'll come out ahead of the game. If there's days out there that the market is just not giving you anything to trade, or you can't find it, or you're having troubles, hey, that's a good day to go fishing. Go play golf. Do what you do. Wait till the market is set up for you. And then there we go. Okay. So let's get on here. Sometimes I get a little winded over this. I apologize. All right. I want to take a look at the T-line and what we call a bullish T-line run. A bullish T-line run is simply when price moves from below the T-line to above the T-line and continues above that T-line without closing below it. That's important. You can have little dips below it, like right there, Probably need to change that color. It's probably a poor color. There we go. There we go. You can have little dips, intraday dips below it, intraday pullbacks, just like right there, intraday pullback. You can have that, but you really need to let that candlestick finish. That's one of the keys to candlestick trading, is allowing it to finish for not the day, but for the time frame you're on. If you're trading on a 5-minute chart, and that's what you're trading this particular chart on, then you need to allow that candle to finish that 5-minute bar. Or maybe you're looking at a 2-hour chart. You need to allow that candle to finish on that 2-hour chart. And then that will give you a good indication of what the attitude of the traders are, because that's all candlesticks are. So when we get this price action that runs above the T line, then we are bullish. So if we do have these little pullbacks like this, which profit taking, the T line is our navigational beacon. Are we on the right side of the trade? And if you're long, and if it gives us this little candle, that some might look at that and say, hey, that's a shooting star. I mean, someone might think it is. And because of that, then they get all bearish and worried and concerned. They dump their trade, and then a week later they look at it and think, what just happened here? Well, if you're a swing trader, you're trading the swing. You're not trading each and every single candle, and having that T line as a guideline helps you stay on the right side of the trade. Now, there are times to get out of it. Yes, there are. And if it comes up today, we'll certainly talk about it. Again, we're a little limited on time, so we have to be careful with that. Candlesticks require confirmation. This is very important. So, you see this start trending up, and you see a bearish engulf here. Most people are just going to dump right out of it. Hey, I probably would too. I'd be scared of that. But you look back at the T line here and you think, well, you know what? We don't have that confirmation. And just because you have a bearish candlestick doesn't mean that it's going to be bearish, all the way down like that. Doesn't mean that at all. And so if you wait for a close below that T line, or you wait for that action to happen, then it allows you to stay in it, and you can see how that trade might have worked out right there. The T line will help you stay in a long trade longer, and it will help you get out of a trade faster that's not working. How many times have we seen or done? All traders have done this, and let me just use this right up here. I know we all have, and we're all guilty of it, so it's okay to talk about it. But the trade comes down, and for whatever reason, we see some sort of support right in there. Okay, I'm going to stay with that chart. And then you have this little bullish candle, kind of a bullish Hiromi candle. Okay, great. Hey, I'm the smartest guy in the world. I'm going to stay with that. But then look what happens. And you chase it down, and you come up with all kinds of reasons to stay in it. Well, I see some support right here, so I think I'll stay with it. Well, in the meantime, you've lost a ton of money here. And more times than not, what will happen is there comes a point when most traders will sell it, and that's where smart money gets in, and that's what happened right here, right on support. Smart money got back in, and now here we are back above the T line. But if you would have just, if you bought in on the cross of the T line or anywhere up in here, rode it up, if you would have sold it right in here, or maybe even right in there, and there, I don't know if we're going to have time today to talk a lot about that, but we're just simply looking at the T line. You could have done something like this right here. You're long. Actually, I probably should have made that green, shouldn't I? You're long. It rallies up, and you come in here and you close it out. And it just doesn't matter how you slice that pie. You've made money. So it's just a great little trend indicator. You hear all the time the trend is your friend. I hear, I pick up books, and I mean, I say it, everybody says it, the trend is your friend. But one thing I think that's lacking is, so what is my friend? what is the trend? And this is a good, consistent indicator for a swing trade trend right there. And you can just see from this that if you were to go short right here, you would cover your short because it did close. You would have made money. And in all honesty, we would have covered the short down here as well. I mean, that's a bucket of money right there. So you would have taken that money. If you get oversold or overbought to the T line, you want to really, really watch that price action in a candlestick shape. So if it started moving down, who knows, you might have gone short right here. You would have made some money. You might have closed it right in here. It wouldn't have been a lot of money you would have made right in here unless you closed it on that gap down. But you can see how that might work where you are, say, short, and maybe you went long, and then there you're short again, and you went long, and you went short again. There is no exceptions. If you would have just followed the T-line, you would have made money. There would have been places or times you would have made more money. In some cases, it might have been a scratch day, but for the most part, I think you can clearly see how the T-line would have worked out right there. This is not a cherry pick chart. This is just the SPY chart, FYI, if anyone wants to know. That's all that is. Here is another chart, and this is what we call a bearish T line run. And a T line run is just simply when price gets itself under the T line or over the T line. We'll stay with the bearish for now. When it gets under the T line and it can't get back over, it just can't do it. It just can't get there. It tries and fails, tries and fails, tries and fails. And we call that a T-line run. Now, the T-line run, there's a little one right here. It would have been broken right here because we did close over the T-line. And it would have been broken right here because it did close over the T-line. But just because it's broken, it doesn't mean it can't fix itself right away if you're short. If you take a look at this right here, this is just a short-lived relief rally. I see this happen all the time with traders. They see something like this, they say, hey, Morningstar signal, let's go, rock and roll. Bulls are really going to take this up now. We've been in a downtrend. More than likely the chart's oversold by some sort of indicator. So all of a sudden traders get into it and they think they've just got a real fast one going on here. And the truth of it is they really don't. All they're doing is trading in a relief rally. And relief rallies can rip the money clean out of your hands very fast because they, make no mistake, it's in a downtrend. And when you've had a downtrend for this long, it's going to take more than just some little simple Morningstar kind of wannabe signal to turn this around. And that's where the help of the T-line comes in. It also helps with curbing your appetite for picking the bottom. A lot of traders like to try to pick the bottom. I guarantee you that more traders bust their account and fail by picking the bottom or trying to pick the bottom than any other trading strategy out there. That is probably the biggest no-no to successful traders. They know that picking the bottom is a bad plan. It usually doesn't work out well. But if you use this method with the T-line, then what happens is, let's make this blue. With the T-line, if we closed up over the T-line and we come back and tested the T-line, that's the key, that test, that low, the high, higher low, or a double bottom. And then from there, guess what? You've now got yourself a little trend started, and now you know that your trend's your friend. And at the same time, what will happen is that T-line will curl up and just get right in underneath you, and that will help you with your trend. Again, the T-line is nothing more than the 8 exponential moving average. Like I said, there's a big story behind it, and given more time, I'd be more than happy to tell you. And come on in the room sometime, and I'll be glad to share it with you. But it's just a terrific directional beacon, keeping you on the right side of the trade. And it's just another one of those things that if it slips, if it slips, maybe you put your stop, say, here. And we probably should be looking at this chart for this case, that chart. There you go. Say you put your stop right in here, and then price starts to move down. Now the scenario I was trying to set up was maybe right here might be better. See how we're down, price comes up, and then price is down. If it came back up and price closed back below the T line, then you might not want to be in it there. But if your stop was right here, if you bought this and your stop was here, then a close below the T line would at least give you a warning. And then if price, or maybe you're using that for your stop, and then if price actually came down through this area here, and we throw the word stop out, assuming that everybody puts stops on. I think when we give these webinars, I think honesty is the best policy. Anyone who knows me or been in the trading, you know that I don't pull too many punches, and I pretty much tell it like it is. So that's what I'm going to do right now. We throw that word stop around like we do it every time. The truth of it is, you take 100 traders, I'll bet 85 don't do it. Just pick any 100 traders you want, because everyone thinks they're smarter than putting the stop on. I don't mean to offend anyone. It's the truth. Hey, I'm there with you. I get it. I really am. But all of a sudden, if you're below the T line and you're below your stop, and you find yourself trying to fight this trade, wait a minute here. I was clearly warned right here. Clearly warned right here. Maybe I should listen to the warnings before this price starts moving down here, and I take a 2% loss to a 5% loss to a 10% loss to a 15% loss. I can't see anybody if you raise your hands, but if you're at your desk or wherever you're at watching this webinar, if that's happened to you, just go ahead and raise your hand. You know who you are. I'm raising mine, by the way. I've been there. I've done that. I want to add another moving average on this. When I created the T line, and I didn't create the 8 exponential, that's not what I'm saying. When I created the T line and how to use it, how to trade with it, about the same time that happened, I added another moving average to it, and it was the 2 EMA. Now, since then, many people have changed that to a 3 just because the 2 might be too fast for them. Hey, I think that's great. I think you should adjust whatever you do that fits your comfortability. I think it's very important for you to be comfortable and to be able to successfully explain what you're using. And if you have any doubts, well, that may be fast, or maybe the 3 is too slow. Heck, maybe you want to use the 5, as far as I know. If it works for you, that's what's important. That's what's important. And the consistency. You got to stay with that consistency. So here's a trade here where we've obviously been in a downtrend. These bulls, bulls. The bulls lost the game here, and the bears just short. Notice how price rallied up. For the 2 to do that, price had to rally up. There had to be some candlesticks in there rallying up. But you can see it didn't go anywhere. Nothing more than a little bit of a just a little up. That's it. Nothing to mount to anything. And that would have been a good place to short, by the way, as we rally up, because I don't know how many people have been to one of my H pattern classes. If you have, then you know that this would be an H pattern right there. You can see the 2 forming that H, and that's a very bearish. The H pattern is very, very bearish. So you can see it move down here, and then of course we got some bottoming candlestick signals. And more than likely what happened here, you can just clearly see it. We have a low, candlesticks brought it up, and then candlesticks pulled it back. We probably made a higher low, and now you see we made a higher high right here. And you can see that with the 2 exponential moving average, that blue line. So let's go into our long trade setup. We rally up, we pull back. That would be a very nice place to start buying, right in there. And you can see from here up, if we go right to where it crossed over, that's a 30% trade. Now, because we are all fairly good traders, I think we're all really good traders actually, and if we're really paying attention, you know, for the 2 to be up here like that, that means that price probably was up like this, and maybe put in a sell signal or something like that. And anytime you move too far away from the T-line, up or down, doesn't matter, you're very likely to see a return to the T-line. So see how price, it got too far away and it returned, except the return is still returning. So it's important to think about that. If this is a 30% trade from here to here, this might have been a 30, 40, we'll say a 40% trade. So, hey, if you were in a trading room and somebody asked me what should I do with it up here and they told me they bought it down here, I would tell them you better sell it. You better take your money. There's not a whole lot of traders out there that can pull off 30, 40% trades. So when that happens, you better do it. But this was a great example of staying in the trade. I have an arrow drawn to this right here because the next slide I want to show you something. And the next slide I would put money that most people would have been out of it. Let's just take a look at that slide. Go find it over here. There we go. This right here, this is what the candle looked like. The black line there, there's the T line. See that little pullback, the blue line? That's what the candle looked like. So if you're up and you put that black candle in, you see if you would have stayed in it, you would have continued to make money. Now, let's be honest. What should we have done with that? Well, because of that candle right there, I would have said, hey, look, sell 50% of your trade and raise the stop up. Because a candle like that, man, I'll tell you, many times it would actually give you a lower low off of that candle's low. So go ahead and take 50% of that trade. Raise your stop up a little bit, just in case. So no matter what, the second piece of that trade, you're going to make money in. I mean, you can't lose in it, outside of some gap down in the morning, something like that. But you can see if you would have stayed in, or if you would have closed half, that second half of the trade would have been very rewarding, and you're using the T-line here. Does every trade work like this? No. Heck no. No, it doesn't. Not at all. Bearish T Line Run. Here's your bearish T Line Run. And you can see how it started to move sideways here. You know, depending on what the candlesticks, you might have closed that position. You would have gone short somewhere up here. You might have closed it here, covered the position. If we started to move over the T-line like this, you definitely want to cover it, because you can see how this thing is starting to curl up. One of our favorite chart patterns is something like this. We call it rounded bottom breakout. But this is this is pretty much what it does with different moving averages, but this is pretty much what it does. Just something like that, and then we move up like this. Well, you know, you hear people talk all the time about things like the golden cross or the death cross. Usually that's the 50-day simple moving average and the 200. Some people say the same thing about the 20 simple and the 50 simple. It's the same principle here. And what you're doing is you're looking for a trend based on those moving averages. Well, if you get a fast moving average like the 2 exponential crossing over the 8 exponential, the T-line, what do you know? You've got yourself a short-term trend starting out. Yes, maybe the 20 over the 50 or the 50 over the 200 might be longer term, but once they cross over and they start moving, it really is out of most swing traders' comfort zone. yes, the 50 may be over the 200 or the 20 may be over the 50, but as far as your personal swing trading goes, now you're lost because those are too long term for most swing traders, seeing how swing trading is from overnight to maybe 10, 15 days, maybe that long. But try using the 8 exponential moving average. My personal opinion, it's perfect. Perfect. It fits a swing trader's need, absolutely terrific. And it just saved a lot for me when I first created that. Okay, let's take a look at the T-line here a little bit. Oops, wrong one. There we go. A little bit of T-line action. This is one of the scanning codes, and don't worry, everybody. I think you're getting a copy of the recording, which means you'll get a copy of this. This is TC2000, a TC2000 PFC, personal, well, PCF, personal criteria formula. If you would like, say, this done in TradeStation or Thinkorswim or whatever program you use, I think we have the ability to make that up for you. Different people in our trading room use different programs, and they're more than willing to help out and build a code. Mine are all TC2000 because that's what I use. But more than happy to help you. Just let me know. So this is the code here, and basically what it's doing, it's looking for stocks in a, I'm kind of adding the 20-day simple moving average with it. We're looking for a little bit of a pullback, and then we're looking for price to be in a trend, slip under the T-line, and then start moving back over, because that's our trigger to buy. I want to stop right there for a second. You know, a lot of people, and I don't want anyone here to get the impression either, but a lot of people will, you know, I might buy a stock right here, and then somebody will say, well, I thought you only buy if it's over the T-line. That is absolutely not true. I will definitely buy down here. I might use a rule, but we're not exclusive to this rule. Let's say this hammer right here. Intraday, I might actually, let's use that little candle right there. This actually fits pretty nice. Say intraday, you can see where it came down for a low. Well, because of this candle action right here, and because of this right here, and that is one of my, I trade a lot after this type of a run, looking for the pullbacks. I might buy this intraday down here. With the idea is, at the end of the day, it must close over the T-line. Now, again, that is not engraved in stone. I can see a chart pattern developing here. I can see buyers here holding these lows in check. Looks to me like the bulls are buying it. So I may not close it if it doesn't close above the T-line. But I do want to monitor how that candlestick closes. And then you can see how it rallied up. That would have made, you know, a nice little, probably a nice one-day trade, really. And then the same thing here. You can see the pullback after a big rally. You see the pullback, all sorts of buying in here. Another thing, too, I get asked all the time, well, where would you buy it? More times than not, my comment is, how about anywhere in that area? How about anywhere? I mean, ask anyone in the trading room. That's very common for me to say that. What if I said, who cares what exactly you pay for it? What if I told you that that was 15% right there? Let me back that up. I gave away the answers. If this was 2%, okay, maybe an entry is important. And we could argue about that, and I think you'd win. But what if I was to tell you, well, that's 15%? How does that change your entry? You see, I think I'm going to win that one. Who cares if you get 0.5% cheaper or 10 cents cheaper if you have a chance to make a 15% trade right there? So You know, where's the entry? How about right there? Remember, we're swing trading. We're not day trading. I've noticed a lot of swing traders have started taking on day trading techniques, and that will bite you. I think that's going to bite you. That's not a game to play. Swing trading is about looking for a chart that's set up, buy the chart, and then swing it to the next high. Don't get me wrong. Let's not throw. I'm not going after poor entries, but the last thing I want to do is miss this trade because of a penny, you know, a tick. And here's another one right here. In fact, this, I don't know what chart this is actually, but this looks like it's set up for a buy right in here. And again, you'll receive this. You're going to get this recording, so you'll get all this right here. And if you contact me, I'll certainly do what I can to get it to you. It won't be hard to do. Just copy, paste it, email it to you. Here's another one that I use, and this is another one. One of them I'm using what we call a moving average squeeze. One of them is squeezes in there, where the low has to be below the T line and the 20-day simple moving average. You don't have to use the 20. I'm just using it because it's keeping everything in a nice bullish trend is what it's doing. Remember, the trend's your friend. So we get that right in there, and then when it starts closing above that T line, that's where you want to buy. And then if it starts closing below the T line, that's maybe where you want to sell. Of course, we are all traders. We've all done our due candlestick education, and you know, if you were in it down here, and if this was a 20% trade or a 15% trade or even a 10% trade, I would bet most people would take at least 50% off the table, at least 50% off the table. And so that would have protected that first 50%, and then that close, you might have closed out on the second 50%. And then same process might have been done right here. You would have started buying it. Look how close the T line and the 20 are. The green line's a 20, by the way. Look how close the T line and the 20 are. That's what we're looking for. We're looking for them to come back, kiss a little bit, come close to kissing, and then we're looking for that swing back up. And these are all set up for the J-hook type patterns, you know, the J-hook continuation pattern, to where, whoops, let's see, where is it here? There we go. Where we rally up, we come back, and that's what we're looking for, that J-hook continuation pattern. The next one would start like that, and this is definitely sloppier. I'd have a hard time calling that a J-hook pattern, actually. More of a little wedge breakout right in here, little flag, pin it, and then rally up. This right here we might call a little bit of a J-hook because it's a little more rounded, coming from that area right in there. So anyway, you know, again, we just don't have a lot of time to go in it in great detail. So what I've kind of done here is I want to go to this last chart, and I just want to say thank you. What we're going to do now is I'm actually going to remove the PowerPoint. We're going to look at my TC2000 screen, and we'll actually look at some charts that we might look at for tomorrow, or Monday rather, or not just Monday, but maybe for the rest of the week. So we'll kind of look at those and see what we can find. But I do want to say thank you for attending the introduction to trading with the T-line. And I would ask that you please check out our website for more information on the T-line as well as many other strategies. You know, I had mentioned just get a hold of me. If you go to the website, if you click on contact, then, you know, a screen pops up, ask you a couple questions, you write your message in there, and it'll go directly to me personally. And I'll see what I can do about getting your question answered. Also, please, 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 we send out a free trial every day. I'm sorry, a free trade idea every day. Click right here, sign up for that. I think that's worth its weight in gold right there. And then, of course, we have a 2-week trial. $27 for 2 weeks. You know, I tell people all the time, hey, look, take the 2-week trial. If you are not satisfied, I'll give you money back. It's not a problem. But there's a lot of information there, and it's worth 27 plus a few zeros in there. So, you know, change a decimal point. It's worth a ton. So I would ask you to at least give it, you know, the free trade idea a chance, and contact me if you need any help or anything. All right, what I'd like to do now is just move this out of the way, and I've got my screen up here. I think everyone can still see it. We have a few minutes left. And what I've done is these are the 2 scans right here that I was working with for you. This one is what I call the bouncing T, which basically stocks that rally up and then bounce off the T line a little bit. This may be one set up for this coming week. We can come over here and put a trend line up there like that. And you can see we've broken out of that trend line. We've rallied, or we fell to the downside, and the bulls have rallied up very nice, putting a nice little consolidation, and we may be breaking out. So this might be a chart. Also pretty decent volume on this. Volume stepped up just a little bit. So this one may be when we're looking at heading for that possible T-line run. Con, I have Con flagged. Con is also one of my, this is my favorite chart pattern of all time right here. And we call this a rounded bottom breakout. It's not bottom picking. Bottom picking would be trying to catch it right here. What we're looking for is to get pretty much over the 50-day simple moving average. And we're looking for a target of always in the direction of the 200-day simple moving average. Now that may not look like a lot. Some traders may say, well, it's not worth my time. Well, I don't know. What if you bought it around $25.15, the center, about the center, you know, just an inside day of Friday's candle? What if you could get an entry right there? Well, I'll tell you what. How does 20% sound? Most traders that I know, and I know a lot of them, they want 20%. You know, from looking at the chart, well, that may not be much of a swing, but you're not trading that. You're trading the percents. Percents convert to dollars. And at 20%, I've never made a trader that has turned 20% down. Here's one, CCRN. You can see how CCRN is just moving up quite nice. The bulls are definitely in charge. Look how we've gapped up right here, and we've broken out. We've broken out. We came right back to the T-line, rallied up, and boom, we're right back with a nice little, yeah, it's a bullish engulf. Nice little bullish engulf here. This is giving us, or the chart is suggesting that we're going to move up higher right here. What if you just follow that T-line? Here's something I like to do. I like to come in here and let's extend the T-line. So what I'm going to do is come just underneath it. I don't care about touching it. I don't care about touching it at all. Just come in there close. You're just trying to get an idea of what's going on here. So just extend it up like that. That's just what the T-line's doing right there. So as long as it stays above that, I might look at that as a trade. Now how about we do this? How about we come over here and just draw a line across that top like that? So this would tell me that anything in this area right here would be safe to buy. I'd buy that. I think the risk reward is excellent, knowing that if it closed below that line right in there, or I might be a little patient, just to wait to see what the T-line does, but that gives me that area that I might be looking at. And then upon a breakout, I can add more.
Hey, Rick, don't mean to interrupt, but we got about 1 minute remaining.
Oh, okay. So 1 minute. Let's go look at one more. Here's one, I think. There we go. That's one I like a lot. It's a little bit low volume, but every trader traded 169,000 shares Friday, and it's 200,000-300,000 shares over the past, back in here on a day. This chart's set up very, very nice, bouncing right off the the 20-day simple moving average, the 200, crossed over the T line, that might be a very nice trade.